Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Coca-Cola.
If you find our talks useful, please consider subscribe, like, and comment underneath, because today we are looking at something pretty wild. Imagine taking like a massive 5% pay cut at your job.
Ouch. I mean, nobody wants that.
Right. Nobody. But then somehow you still bring home this record-breaking paycheck at the end of the year anyway.
It sounds impossible.
It does. But that is exactly the financial magic trick Coca-Cola just pulled off in their latest earnings cycle. And it's really the crux of what we're analyzing for you today.
It really is. It defies the standard macroeconomic gravity we are seeing right now. Because if you look at the broader landscape today, today being Sunday, April 5th, 2026, the S&P 500 is pulling back.
Yeah, it's definitely been a rough stretch.
Very rough. There is this palpable sense of fear dictating the flow of capital, and it's almost entirely tied to the ongoing geopolitical tensions in the Middle East.
All right, the macro environment is just incredibly jittery right now. But within that sea of red, we are seeing a remarkably clear buy-the-dip signal emerging.
We are.
So our mission today is to unpack this highly bullish thesis for you. We're scoring it an 8.5 out of 10. We're looking at why Coca-Cola is currently offering a remarkably rare 12 to 24-month wealth-building window.
And we should clarify, this isn't your grandfather's story of just, holding a safe stock to survive a market downturn.
Exactly. This is a defensive blue chip that is fundamentally accelerating its earning power. It's actively breaking through these long-standing profitability ceilings right as external fears are artificially depressing its stock price.
Which is exactly what sophisticated wealth builders look for. You don't just want a place to park your cash so it doesn't evaporate. You want operational leverage that is firing on all cylinders but is disguised by a broad market panic.
Totally. So let's get right into that operational leverage, specifically this earnings breakout. Because for the longest time, Coca-Cola had this invisible, impenetrable ceiling.
Yep, the $3 mark.
Right. They just could not seem to push their comparable earnings per share past $3.
Yeah.
Year after year, it acted as this heavy resistance. But in 2025, they finally smashed through it.
And we really have to look closely at the architecture of that breakout. Because hitting $3 isn't just, a psychological win. It represents a definitive inflection point in their pricing power.
How so?
Well, in the fourth quarter of 2025, they delivered comparable earnings per share of 58 cents. That is a 6% year-over-year increase.
Okay.
And looking ahead, management's guidance for 2026 projects a 7 to 8% growth rate. They're targeting an earnings per share range of $3.21 to $3.24.
Which is crazy when you think about the currency issues. I mean, we all know how brutal the strong U.S. dollar has been for multinationals lately.
Yeah.
Coke ate a severe 5 percentage point currency penalty.
A huge hit.
Yeah, a hit that usually derails an earnings report entirely.
Yeah.
But their underlying volume pricing was so aggressively strong that it completely masked the foreign exchange damage.
Exactly. When you absorb a 5% penalty on currency conversions and still break your all-time earnings ceiling, it tells you, everything you need to know about consumer demand. And it highlights the distinct advantage of their business structure. Coca-Cola is what we call a pure-play beverage model.
Okay, let's pause there. Explain the how behind that pure-play advantage for a second, because it makes me give an analogy. I think of a master chef who only makes one dish, but they make it perfectly right.
I like that, yeah.
Contrast that with their direct competitors, companies like PepsiCo or Mondelez. They're running these sprawling empires. They're trying to manage soda and potato chips and packaged cookies all at the same time.
And right now, we are seeing those competitors get really bogged down by climbing agricultural input costs and much weaker demand in the snack aisle.
So how does Coca-Cola avoid that trap?
The how really comes down to hyperfocus and their franchise bottler model. Coca-Cola doesn't want to figure out the complex, shifting supply chains for a dozen different snack categories.
Right.
By staying strictly in beverages, they optimize one singular, highly efficient global distribution network. But more importantly, Coca-Cola fundamentally operates as an asset-light company.
Asset-light, meaning they don't actually own all the heavy machinery.
Exactly. They don't own most of the bottling plants or the fleets of delivery trucks. Their local franchising partners do.
So when local labor costs spike or, gas prices surge, Coca-Cola isn't the one absorbing the brunt of that margin compression on the logistics side.
Precisely. The heavy capital expenditures, so the factories, the trucks, the local union contracts, are largely borne by the bottling partners. Coca-Cola just focuses on marketing the brand and selling the incredibly high-margin syrup concentrate to those bottlers.
So that is how they widen their profit margins while their sprawling, snack-heavy competitors are seeing theirs shrink.
Yep. They pass through price increases to the consumer because of immense brand loyalty, but they aren't carrying the heavy industrial baggage of actually moving the liquid to the grocery store shelves.
It's brilliant. So they have achieved this masterclass in operational efficiency, and on paper, they are earning more money than ever. But earning money on an income statement is one thing. Earning money can be manipulated by accounting adjustments or one-time tax benefit.
Oh, for sure. You have to look at the cash.
Right, let's look at the actual cash.
Yeah.
How much cold, hard cash did this machine actually spit out last year?
The number is staggering. In 2025, the company generated $11.4 billion in free cash flow.
11.4 billion.
Yeah. And that is purely the cash left over after paying all operating expenses and capital expenditures.
In a market where high-growth tech companies are actively burning cash to stay relevant in the AI race, a number like 11.4 billion isn't just safety, it's a weapon.
It really is.
And they are deploying it aggressively. I saw they recently announced a massive $1.05 billion investment specifically to boost their operations in South Africa.
Which is a brilliant deployment of capital when you understand the dual strategy of a global beverage giant. Because in mature markets, like the United States, Coca-Cola's growth is primarily driven by pricing power.
Right, they aren't going to suddenly convince Americans to drink twice as much soda.
Exactly. Instead, they introduce smaller, premium packaging and charge slightly more per ounce. But in emerging markets, it is an entirely different game.
It's a land grab for volume.
Spot on. It's all about volume. The South Africa investment is basically a billboard to the market that they see explosive volume growth on the horizon. When a mature company deploys over $1 billion into emerging market infrastructure, they are building the physical pipes to capture a brand new, expanding middle class.
And locking out the competition.
Exactly. They are cementing a localized network effect that regional upstart competitors simply will not have the capital to disrupt.
Okay, let's talk about how all that cash flow impacts the retail investor directly. Because we have to talk about the dividend.
Always.
They just raised the quarterly dividend to 53 cents a share. That is their 64th consecutive year of dividend increases, which keeps them firmly enshrined as a dividend king.
A very exclusive club.
Right. And at current valuations, it is offering a 2.7% yield. But wait, hold on. Before we crown them the perfect dividend stock, I read an op-ed in the financial media just yesterday that basically accused Coca-Cola of writing checks it can't cash.
Oh, the payout ratio argument.
Yeah. They pointed out that the payout ratio is sitting on the higher end for the consumer staples sector.
Yeah.
Are they actually over-leveraging themselves just to keep up appearances and protect that 64-year streak? Like, with over $11 billion in free cash flow, is this dividend scrutiny a real red flag for a wealth builder or just financial media clickbait?
It is a really common argument, but we have to separate the percentage from the absolute reality. Because a payout ratio simply measures what percentage of net income goes out the door to shareholders.
Right.
And yes, mathematically, Coca-Cola's ratio trends higher than some peers, but this is exactly where context defangs the headline risk.
Because of that $11.4 billion free cash flow number we just talked about.
Right. When your free cash flow is $11.4 billion, high percentage of that is still a monumental absolute dollar amount. The buffer is just massive.
That makes sense.
They can comfortably distribute those dividends to shareholders, deploy $1 billion into South Africa, reinvest in global marketing, and still have billions left over. The headline writers are fixated on a percentage metric, but institutional investors are fixated on the actual billions of dollars sitting in the bank.
So it's noise.
Completely. The dividend is incredibly safe, and raising it for the 64th consecutive year is management's way of publicly signaling total confidence in their cash-generating machinery.
That makes perfect sense. The cash buffer acts as an ironclad guarantee. So we have the fundamentals mapped out. The balance sheet is a fortress. Let's look at how the institutions are actually reacting to this, because the contrast on the charts right now is wild.
It really is.
As we establish, it is early April 2026. Looking back at the close of late March, the S&P 500 had declined roughly 6% year-to-date. But Coca-Cola, up 10.07% year-to-date.
That divergence is the absolute definition of relative strength. While retail investors were panic selling the broader market due to geopolitical headlines, sophisticated institutional money managers were steadily and quietly accumulating shares of Coca-Cola.
Smart money moves in silence.
Exactly. From a technical standpoint, we are seeing incredibly resilient support established near the $76 level. And the stock is currently pushing up, testing resistance near its 52-week high of $82.
And the major analysts are upgrading their models to reflect that momentum too. Bank of America recently raised their price target to $88. And some of the deeper intrinsic valuation models we are tracking actually point to $90.
Which is huge.
It is. That implies a nearly 19% upside from recent trading levels. That is a massive premium for a supposedly boring defensive stock.
What is particularly telling about that Bank of America upgrade is the specific rationale they cited. They pointed directly to a supportive, bottler-centric message.
Meaning they are rewarding the exact asset-light franchise model we unpacked earlier.
Completely. Wall Street is recognizing that Coca-Cola has insulated itself from the worst of the inflationary pressures by letting the bottlers handle the heavy lifting. And that is driving a massive sector rotation.
Right.
You have sticky institutional money, trillions of dollars managed by pension funds and asset managers, actively rotating away from the volatility of the technology sector.
We've seen exactly that with Apple's recent struggles to gain meaningful traction in the AI space. For the last few years, tech stocks were treated as a guaranteed high-growth asset.
Yep.
Now, institutions are suddenly treating them like highly volatile venture capital, so they pull their money out. It's like a lifeboat in a stormy sea, honestly. But explain why they view Coca-Cola's pricing power as this ultimate shield against inflation, making it the lifeboat when tech starts taking on water.
Well, that is the exact mechanism of the rotation. If you are managing $50 billion, you cannot afford to have your capital wiped out by a bad earnings quarter in the tech sector or, a supply chain issue in the semiconductor space.
Thanks, right.
Right. You need certainty. Coca-Cola's pricing power provides that certainty. Because their product is viewed globally as an affordable daily luxury, they can continually nudge prices higher without destroying consumer demand.
Even when things are tight.
Exactly. That guarantees a reliable compounding return regardless of whether inflation is running at 2% or 4%. They treat Coca-Cola like a high-yield savings account that also happens to sell soda.
So we see the internal machinery working perfectly, and we see the smart money flooding into the stock to hide from the tech volatility. But if you are a wealth builder mapping out a position for the next 12 to 24 months, you can't just buy and tune out.
Definitely not.
What are the specific hurdles and catalysts that need to be circled on the calendar right now? Let's start with the risks.
The primary bear case risk to this entire thesis remains the currency headwind. As we noted, they took a 5% penalty at the end of last year. If the U.S. dollar continues a relentless upward trajectory, gaining significant strength against global currencies, it will act as a continuous drag on their reported international revenues.
Right.
It won't break the company, but it could artificially compress the profit margins they report to Wall Street in 2026.
Because every euro or yen they earn overseas simply converts into fewer dollars back in Atlanta. So the upcoming first quarter 2026 earnings release, which is scheduled for late April, is going to be the absolute immediate litmus test. The market will be dissecting that report purely to validate if they are on track for that $3.21 annual guidance. If the currency drag is worse than expected, the stock will react.
It will. But if we pull the lens back from a single quarterly report, there are massive macroeconomic tailwinds setting up, the most impactful being the Federal Reserve's trajectory on interest rates.
Oh, this is big.
Because of its legendary reliability and its 2.7% yield, Coca-Cola functions as a high-quality bond alternative for a massive segment of the investing world.
Let's explain the mechanics of that relationship for a second. If the Fed signals they're going to start cutting rates, what exactly happens to a stock like this?
It creates an immediate capital flight into the stock. When the Federal Reserve cuts the benchmark interest rate, the yield on newly issued government bonds and corporate debt drops. Suddenly, a safe, guaranteed 2.7% dividend yield from a dividend king looks vastly more attractive to income-seeking investors than a suddenly lower-yielding treasury bond. Historically, the moment the market prices in concrete rate cuts, high-quality, dividend-paying defensive stocks see a dramatic surge in institutional buying.
And that brings us to perhaps the most fascinating catalyst of all, the geopolitical landscape. Here's where it gets really interesting. The S&P 500's recent pullback, which has effectively kept Coca-Cola's valuation grounded and created this entry window, has been purely driven by tensions in the Middle East.
Right.
It has absolutely zero to do with the company's internal supply chain or the global demand for its beverages or its profit margins. So to translate the market mechanics here, if a ceasefire is announced tomorrow, or those geopolitical tensions simply de-escalate, does this rare window to buy a dividend king at a discount just snap shut instantly?
It absolutely does. The stock market is not a reactive historical record. It is a forward-looking pricing mechanism. Right now, it is pricing in an elevated premium for global geopolitical fear.
Yeah.
If a catalyst removes that fear from the equation, the market does not take a week to slowly adjust. The algorithmic trading models and the sidelined institutional capital reprice the asset immediately.
It's like a rubber band that is currently pulled tight. The moment the tension is released, it violently snaps back.
Yes, that is what we call a rapid mean reversion bounce. The stock will instantly snap back to its fundamental intrinsic value. So the entry window we are analyzing is heavily dependent on the current climate of external macro-level fear.
Right.
Once that external fear evaporates, a stock boasting an 8.5 out of 10 fundamental rating with record profitability will command its full premium virtually overnight.
Okay, let's consolidate everything we've covered today. What is the definitive elevator pitch for this opportunity? You have a legacy company that has fundamentally altered its profitability profile, finally breaking through a historic earnings ceiling of $3 a share.
A huge milestone.
They're successfully executing an asset-light, pure-play beverage strategy that perfectly shields them from the supply chain nightmares plaguing their competitors. They're generating an astonishing $11.4 billion in fortress-level free cash flow, which easily secures their 64-year streak of dividend increases.
Exactly.
And right now, institutional money is aggressively rotating into their localized pricing power to escape tech volatility, all while the stock trades at a relative discount strictly because of broader geopolitical market fears.
It is a textbook wealth-building setup. It represents the perfect alignment of internal operational excellence with an incredibly opportunistic macroeconomic environment.
Before we wrap up today's analysis, I want to leave you with one final, slightly provocative thought to mull over as you monitor your portfolio this week. We spent time detailing the bear case risk of a strong U.S. dollar causing currency headwinds, which is undeniably a vital metric.
It is the primary drag on their reported numbers right now.
But consider the inverse of that dynamic. In 2025, Coca-Cola shattered its historic earnings per share ceiling. They achieved record-breaking profitability, and they accomplished it while actively swimming against a punishing 5% current of foreign exchange headwinds. Their localized pricing power and underlying volume demand were so fiercely strong that they completely overpowered the macroeconomic drag.
They really did.
So keep a very close eye on currency trends over the next quarter. Because if the macroeconomic tide turns and the U.S. dollar begins to weaken over the next 12 to 24 months, those heavy headwinds instantly flip into powerful tailwinds.
Oh, absolutely.
If this company can hit record historic profitability while swimming against the current, just how high could that earnings ceiling actually go when the macro current is finally pushing them forward?
It completely changes the valuation models. A weakening dollar could trigger multiple quarters of massive, unexpected upside surprises.
Exactly. Keep a close eye on the dollar index. Watch closely for that late April Q1 earnings report. And remember that when the broader market gets stormy, the smartest capital always seeks out the most reliable high-yield savings account it can find. Until next time.